Hello, everyone. Welcome to today's session. Today is financial literacy for business owners. You are here in Strategic Boardroom, and I am your host, Mark Dolfini. It's really good to see you. I am really excited about this. This is one of my very favorite sessions to teach, which is around financial literacy for business owners specifically. And I would like to know about you a little bit. Please let me know where you're from and what line of work that you're in. And that way we can make this a little bit more relevant to you. We've got a lot of information to cover in a very short period of time. So I want to make sure, of course, that we are doing that, we're getting to all the information that you are interested in. And I'm going to ask you just a couple quick things. Please let me know again, where you're at, and what line of work that you're in, and also if you've got any real misunderstandings about financial literacy. Because here's the thing I just want to let you guys know is up front, we have a course tomorrow, and there's still time to sign up. There are still a few seats available for the Money and Finance Business Owner Bootcamp. There is going to be so much information that is going to be available on that. We're going to be walking through everything from soup to nuts that you need to know as a business owner, not trying to make you into a bookkeeper, not trying to make you into an accountant or a tax accountant or anything along those lines. We're going to be talking specifically to you about things that you need to know as a business owner, where you can, the basics of a balance sheet. We're going to talk a little bit about balance sheets and income statements today. We're going to get into more of the granular details on those things tomorrow. But also, once you start understanding what a healthy balance sheet looks like and what a healthy income statement looks like, then we're going to go on the other side of that and really start getting into a lot of different things about being bankable, about being able to borrow in the name of a business, and understanding what to say to loan officers, what not to say to loan officers, understanding what the nuances of a FICO score. And you might be thinking, well, I'm sorry, are we still talking about business financing? Yes, we absolutely are, because if you think that that banks do not look at your FICO score, even though you're borrowing in the name of a business, you're kidding yourself. And how many different credit scores are there? Most people think there's 3. There's actually significantly more. We get into all that stuff tomorrow, not to mention different ways to hold cash, different ways to hold cash in a tax sheltered way, and all sorts of different aspects. So we're getting into all that tomorrow. If you are interested, I just put the link up on the screen. If you would like to sign up, there is a cost to it. But here's the thing. If we get to the end of it and you think it was trash and you think it was a complete waste of your time, I will absolutely give you your money back. And the other thing that I'll make a point here real fast too is it also comes with the Money and Finance Advanced video course. So you get that as well, just for signing up with the Business Owner Bootcamp. So you don't just get that, you'll get that plus the replay plus everything else. So I'll talk more about that at the end, but right now let's get to the agenda. And specifically, we're going to get into just some nuances around the Viper framework, the systems part of the business that you're looking to set up for your business. Then we're going to get into the 4 core functions of business: the lead generation, the sales, the operations, and the accounting. And we will be talking about the accounting function today. So let me you guys are a quiet bunch so far. Let me know who of you here thinks that you're a numbers person. Are you a numbers person? Are you not a numbers person? Either way, how do you feel about being a numbers person and not being a numbers person? And I'll talk about that here in a second, especially for those of you people like, oh, I'm not a numbers person at all. Relax. It's fine. You don't have to be a numbers person. I'm going to talk about that here in just a second. So we'll talk about the financial statements, the balance sheet, the income statement, and especially where is all my cash? Like, dude, where's all my cash? I'm growing this business. Why do I not have the cash that I thought I should have? I'm making more money, but I can't seem to keep any. We're talking about a phenomenon called growing broke. And of course, we'll talk about the different resources, and we'll talk about the boot camp if you are interested on that tomorrow. So it is tomorrow, so there is still time to sign up if you are interested. All right, so these are all the different books that I have written. That's not really relevant, but this book right here is The Time Wealthy Advantage. This is what I published last year in May of 2025, and this is all around the Viper framework that we're going to be talking about here for just a hot second. And the Viper framework is an acronym for vision, infrastructure, process, execution, and reporting. And this is how you're going to look at your business from a top-down perspective. So when you're looking at your business, you are going to be looking at it from a strategic perspective and not just simply a perspective that is going to be very tactical and kind of bolting on these different tactics here and there that don't seem to really fit or play nice together. And that is the Viper framework, everything from top to bottom. So let's get into that. The vision component to your business is everything related to around personal vision and business vision. So your personal vision specifically is where it is that you want to go. So you might be thinking, okay, well, where do you want to go? Where do you want to go in life? I see Jessica, where is it that you want to go in your life? Joelle, where do you want to go in your life? If your life wasn't defined by what you did for money, if your job description wasn't a life description, let's say you woke up with $20 million in your bank account tomorrow, what would your life look like from day to day? And okay, fine, go out and buy some stuff, whatever. But what would your life look like from day to day after, if you didn't have to be defined by income generation? And it doesn't mean that you don't have to be productive anymore. I mean, I would still, I do pretty well. But if I woke up with an additional $20 million in my bank account tomorrow, I probably would be doing the same thing that I'm doing because I really enjoy what it is I'm doing. I love teaching. I love reading and writing books, and I love doing research. Those are just things that really light my fire. So again, where do you want to go in your life? And then you start to give consideration to a business vision. Once you understand your personal vision, where that's where you want to go, your business vision is going to say like, okay, great. How are we going to get there? And here's the interesting thing is that there's a lot of people who I know who are business owners who never give any consideration to a personal vision whatsoever. And that is truly to their detriment. And the problem with that is because it creates a real danger. And the danger in creating a business vision before creating a personal vision is that you end up creating a life that exists to serve the business. And I'm just telling you that sucks. It's an empty well that just never gets filled in. I've sat in many masterminds and seminars and conferences with people who were legitimately making 6 and 7 figures a month net take home. And meanwhile, their life at home was a disaster. They didn't have hardly any relationship at all with their spouse. And if they did, it was an antagonistic one. They didn't really have any relationship at all with their children. And as a result, you know what they were more interested in? Trying to put another comma in their bank account. And I'm not suggesting that money isn't irrelevant or, doing business is irrelevant. I'm not saying that at all. I'm just saying it can't come first. Otherwise, you're going to create a life that exists to serve that. So I spent more than a decade, not quite 2 decades before I figured it out. But in my 20s, you were never going to tell me that this was anything, worth chasing. So let's just real quick, I'm just going to talk about personal vision really fast, and then we're going to I'll put the fries in the bag, and then we'll talk about the personal financial stuff. But the one thing I really like to do from a strategic perspective is put this, think about this in the context of a 100th birthday speech. So you're turning 100 years old, and I would want you to think like, okay, if you're turning 100, you're going to put a speech together. Who would you want to be in the room? Who would you want to be there? And what would you say? What are the things that you would say? What would you talk about? What would be the legacy that you would want people to carry outside that room to other people after you were done speaking? So think about that. And if 100 years is too, let's say you're 20 now, and like, dude, I'm 25 years old. I can't think when I'm, 100 years old. That's like too far out. Then think of the next major milestone in your life. Maybe it's your 10-year high school reunion. Maybe it's your 10-year anniversary. Maybe it is when your kid turns 18. Something along those lines. Think of that as a milestone that you could think about in terms of a speech. And again, same type of thing. What would you say? And who would you want to be there? All right, so let's get into the business vision. The business vision, and from here on out, we're going to be talking specifically about business stuff. But from the business vision perspective, there are 3 C's that are absolutely critical to the DNA of a company. And these 3 C's are they're just foundational. When I get hired, whether I'm being hired as a strategist or I'm getting hired as a fractional CSO, which is a chief strategic officer, and I like the fractional CSO because it pays better. But basically I'm doing the same thing, but just different sizes organizations. But whenever I get invited into an organization and I'm asked to look at the viability of the organization because they have got turnover problems, whether that's turnover with staff, turnover with their clients, They've got turnover of vendors. They've got a culture problem where they've got people who are not getting along. They're not playing nice together. Maybe they're having trouble with leads. Maybe they're having trouble with sales. Maybe they're having trouble with profitability. Any of those things are in some way related to these 3 C's I'm about to put together. And that is core purpose, core values, and client avatar. All 3 of those things are absolutely critical to the well-functioning part of an organization. And most times when I'm looking through these 3 lenses and I'm looking for cracks, I usually find them in one of these 3 areas. So let's get to core purpose. Now you might be thinking, what does this have to do with financial literacy? It has everything to do with financial literacy because it has everything to do with profitability, and it has everything to do with the well-running part of your business. So I'm going to go through this super quick, much quicker than I normally would in a deeper dive under the strategic growth multiplier or business plans 101. So just hang in there with me just for a second because this will make sense here at the end. But the core purpose is really about what specific business are you in and what problems do you specifically solve. When I see a lot of businesses and they're not really specific in their answers, when I see a lot of businesses that struggle with profitability, or they're struggling to bring in more clients, or they're really struggling with sales, it's because they're not necessarily clear on their core purpose. There's other things, but when they say, oh, we do all these different things, that's fine. You can be like the car mechanic. The car mechanic doesn't just replace the left headlight. No, they probably replace the left headlight and the right headlight, and they probably do brake jobs, and they probably do mufflers, and they probably will balance and rotate your tires. All sorts of things. Will they do transmission work? Generally not, because they leave that up to someone else, because that's a specialty that they just don't know. So they're really obnoxious about what they're good about, but they're also obnoxious about what they won't do. Will they work on dump trucks? Probably not. They like passenger-rated vehicles. Will they work on your lawnmower? Again, probably not. They probably can't charge enough to make it worth their time. So this is what I'm saying about the core purpose, is you've got to be really specific about what it is that you do and don't wander from that core purpose. Let's look at core values. Core values is what is important to you about this business, and how would the world be worse off if you went out of business? You might be thinking, this sounds super squishy. Are we talking about financial stuff or not? Give me a little bit of latitude here on this one, because when core values are not really clear in an organization, this is where a lot of those internal struggles come from. This is where they're going to get a lot of turnover in their staff. This is where they're going to get staff that like, oh my gosh, how did I wind up with this person, right? Or they're going to get customers that are not in alignment with their core values. And they're like, oh my gosh, how did I wind up with this person? Same type of thing. So you have to take the time to actually define the core values that are important to you in the organization. If you do not take the time to define the core values, your core values will be defined by the strongest personality in the room. That's just the way it goes. So I'm just saying you have to think about that in terms of what's really important to you in your organization, because if you don't take the time to define these core values, again, they end up getting defined by the strongest personality in the room. And here's the problem. The core values are directly linked to your company culture, and the company culture and the company brand have an inextricable link. So the company culture is what's experienced by the people inside the organization, and the company brand is what's experienced by people outside the organization. So this is why, again, you'll have lots of different turnover, whether it's staff or clients, because these core values are not well defined. So let's talk about the client avatar. These are the people outside the organization that you're trying to attract. Again, these are the people who drive the finances, right? These are the people who drive the sales. These are the people who are bringing the wealth to your door. So you have to know these people particularly well, and who specifically and ideally do you want to serve? And you want to define these people really, really well. And you want to define them geographically, demographically, and psychographically. Again, this is pretty straightforward. The geographics is where they are. The demographics is who they are. Are they married? Are they single? Are they, are they divorced? Do they have kids? Do they have no kids? So, so forth and so on. And the psychographics is how they think and how they buy. How they think and how they buy. So if you're thinking about making an investment in marketing, it's really important that you're not just going to be throwing money up against the wall to say, oh, I'll put money in billboards. Okay. Who is it targeting? Well, the guy told me that 50,000 cars a day drive by that billboard. Okay. Are any of them your customer? Are any of them going to be buying from you? This is why you have to be really discerning, because I'm telling you, salespeople are really good at selling their thing, and that's about it, because they're not selling your business. If a really good salesperson is going to understand your business and understand it's not just about visibility, it's also about getting them to actually take action, getting the customer to actually do something rather than just branding. Branding is just lazy. I'm sorry, it's just lazy. And there's no way to economically track if that person responded because they drove by at 70 miles an hour and saw your billboard. It's rare that you're going to hear people say, "Oh yeah, I drove by your billboard on the interstate and that's why I came in." Okay, I'm just telling you, it's pretty rare. So this is where you have to understand psychographics. So psychographics is how they think and how they buy. I want you to think of the phrase ALIA: their attitudes, their lifestyles, their interests, and their aspirations and goals. Once you know their attitudes maybe towards your industry, their attitudes towards your business. Once you know those attitudes, it's really easy to market to them because you can address those attitudes. And again, that's when you're being really efficient with your advertising dollars, with your money. What about their lifestyle? Understanding their lifestyle, if they're young and jet setting, or old and they're kind of settling into retirement or whatever it is. Their interests, do they like American football? Do they like European football? What do they like? Do they like NASCAR? Do they like Formula One? Either way. And what are their aspirations and goals? If you understand their aspirations and goals and you can align your product and service to their aspirations and goals, it's almost a license to print money. So these are the 3 C's of business: vision, core purpose, core values, and client avatar. And that's going to put the fries in the bag on vision. So we're talking about the Viper framework. We're setting this up top down. So let's talk really quickly about infrastructure. So when you're thinking about infrastructure and you're thinking about purchasing infrastructure improvements, and this is something that comes directly out of your profits of the business, this is the bones of the business. These are things like your desks and your chairs and your software and your phone systems and things like that, right? And, the websites, and that is all improvements that you need for your business. Otherwise, if you don't have enough infrastructure, you have to beef it up with process. And process is what we're going to talk about next. So when you look at the Viper framework, you've got vision, you've got infrastructure, next is process. Process is simply how you do stuff. And it's how you do stuff from both a tactical perspective and from a strategic perspective. Tactical process is things like how you do stuff from your standard operating procedures, your checklist items, things like that, your day-to-day activities. When you're looking at, it's like your opening procedures, your closing procedures, how you prepare bank deposits, how you answer the phone, things like that. Very, very boring stuff that no one ever wants to take the time to document. When you're looking at strategic planning, on the other hand, this is where you think of the infrastructure and the process. That is the system. That's like the battleship that you just built. Now, you don't want to leave that battleship just moored against the harbor. You want to take it out and go make some trouble. That's what strategic planning does. You're not just going to allow your business to be bolted to the dock and get battered around by whatever economic winds happen to be blowing around. No, you want to drive that business strategically towards one specific direction. Stands to reason. So that you do this by thinking of 3 P's, which are people, purpose, and promotion. You need to think of the people that you need to drive your strategic plan. Who are you going to need to help affect the plan? That might be new employees, that might be existing employees, that might be new vendors, might be existing vendors, whatever. It might be new subcontractors or existing subcontractors, but it's also directed towards the people outside the organization that you're targeting. Could be your client avatar or a subsection of your client avatar. Let's say that you like working with business owners and you're just targeting female business owners. Make sense? So this is why it's really important to get really specific on the people that you're doing. Because again, if you are going to be investing in marketing, if you are going to be investing in software that's going to scrape and find these people, or if you are going to be investing in something, some sort of infrastructure, some sort of process, or some sort of marketing, doesn't it make sense that you are highly targeted as much as you possibly could be? Makes sense. The purpose has to be also in alignment with your core purpose. So once you're in alignment with your core purpose, the reason for strategic purpose, and again, that's where if you're thinking like, okay, well, what are we trying to do? Are you trying to expand market share? Are you trying to launch a new product? Are you trying to launch a new service? Are you trying to go into a different market altogether? Are you trying to vertically integrate into a market? What are these things that you're looking at in terms of your strategic purpose? So the reason that you define this and you look through the lens of your core purpose is because it helps keep you from chasing too many rabbits. Because how many business owners do I know that have that shiny object syndrome where they're like, oh my gosh, yeah, this is such a great opportunity. I should go over there and do this. Okay, that's great. But the problem is, does the strategic purpose align with your core purpose? And if it doesn't, that's when you have to recognize, I need to get out of this, right? Like I don't need to be, that would be as if the strategic purpose does not align with the core purpose. That would be like if Starbucks started selling chainsaws, right? It doesn't make any sense. So that's why you have to make those two things reconcile. And then you're looking at promotion. Promotion is just repeating yourself a lot, right? Like pretend you have like a lot of teenagers in your house. Okay. So if you have promotion, I want you to think of promotion from the perspective of communication, both outwardly to your avatar or whoever that target audience is, but also promote it internally. And anytime you have some sort of change happening in your organization, especially something when you're affecting a new strategic plan, you have to promote it internally just as much as you're promoting it externally. And what do I mean by promotion? I mean, like you have to repeat yourself often, like a lot. And that is something that just is the nature of the game and does not matter. You have to have a promotional component to that. So that is process. Next is execution. Execution is, this is a great quote put up by General George S. Patton, which is a good plan violently executed now is far better than the perfect plan executed next week. And that is so very true. And the reason I bring this up is because most plans fall apart in execution. And most times it's because business owners, as much as I love you, you have way too many priorities on your to-do list. And having too many priorities has the same impact as having none. So that's why I like to come up with something I call Daily 5. The Daily 5 are up to 5 highly specific actions that you can take, which are going to move the needle towards your vision or your strategic plan, one or the other. Personally, I like 3. 3 tends to be a really good number for me, but up to 5. That doesn't mean 50, doesn't mean multiples of 5. It means 5 very specific needle-moving activities that are going to move you toward your vision or your strategic plan, okay? So you have to think about, like, is checking email on that list? Generally not. Is checking voicemail on that list? Generally not. Is calling 15 cold leads on the list? I could see that would be one thing, okay? This webinar for me is one thing. This is one of my 3, again, 3 is a better number for me, of highly specific actions that I can take that are going to move the needle towards my vision. Okay, so this is that is the execution part. This is the last component of the Viper framework, which is reporting. And reporting is just, it's letting us know how we did. And we do that through both lead metrics and lag metrics. Lead metrics are based on the actions and activities. You're just measuring what you did. You're just measuring your activity. You're measuring how many cold calls did I make? How many cold emails did I send? How many webinars did I do? That is something you can directly control. You can control your lead metrics. Do you have any real control over your lag metrics? No, you have no direct control over it. You can have a really good batting average and have a really horrible day because you don't have any direct control over how many people buy. So you can control how many times you swing. You can control how many times you get up at bat, but you really don't have any control of how many times you get up at bat because you can't control how many times you get appointments, right? You got to get people to say yes. You got to get people to agree to that. So the lag metrics are just the results of the actions and activities. So if you show up to someone's business and they throw you out, you can't really count that as an appointment. But if you show up and are able to book an appointment, and let's say you have to show up to 10 to get 3. Okay, well, that makes sense. So now it's just a numbers game. So now I'm going to show up to as many as I possibly can, knowing that I'm going to book 30%. That's my ratio that I'm going to shoot for. I'm going to try to get to 200 businesses so I can book 60 appointments. Okay, so that's how you play that game. So that is the Viper framework, the vision, infrastructure, process, execution, reporting. That's now that we've got this strategic framework for your business. Now let's look at how to look at this from a cross section, looking at the 4 core functions. Now the 4 core functions of business are as follows. They are lead generation, sales, operations, and accounting. And your customer's journey through your business happens in that order. They first experience the lead generation, then they experience the sales process, then operations, then accounting. And that is something you have to understand, that everything needs to absolutely positively has to support your lead generation function. Because the truth is this, you can have the best, most efficient business. You can have, in fact, you can have the best product or service on the market. You could be a paragon of truth, justice, and virtue. And your sales technique so dialed in, you could sell ice to Eskimos and voting booths to Castro, and you can still starve because you don't have enough leads. And that's the real crux of the issue. So I keep bringing this back to lead generation because that's what the financial function of the business really needs to support. Because whether you're doing that through capital infusion, meaning your own investment, or you're reinvesting profits, that's something that's just going to happen literally forever. Because the minute you lean back and take your foot off the gas with lead generation, that's when you're most at risk. And I have, unfortunately, witnessed too many companies that took their lead generation for granted, and they did it at their own peril. So you just can never take your foot off the gas when it comes to lead gen. The sales conversation is the lead generation was what starts the conversation. The sales conversation is what closes the conversation. So basically you're closing it and handing it off to the operational function, right? But it's just continuing the conversation that started in the lead generation. And it also understands that effective selling is about finding solutions, not holding people's heads underwater until they say yes. The operational function, if you're generally going to get stuck, this is where you're going to get stuck. You're going to get stuck in the job. You're going to get stuck in the thing. So if you build websites, generally this is where you get stuck. If you put on roofs on houses, this is where you get stuck. If you're a plumber, you get stuck doing the plumbing, so on and so forth. That's generally where a lot of people tend to get stuck. If people are going to ignore something, they generally ignore the accounting. Okay. And I have an accounting degree, and it sounds and I've said these very words. Well, I've got more money in my bank account this month than last month. I must be doing okay. Well, right. And I have an accounting degree, and I said that. And the problem is the accounting function is so incredibly important because the accounting function collects the money, which I'm assuming we like that. It pays the bills, which I can tell you your vendors like that. It tracks and measures everything that happened. And not only tracks and measures everything that happened, but it also forecasts. It helps you figure out what will happen and plan for what may happen. And it also establishes budgets, and it also helps you chart the course for the future. So this is really, really critical, a critical function. And if you're ignoring this, unfortunately, it makes you far less bankable. Because when people come in, they're like, I don't know, I make a lot of money and I can't get a bank to loan me money. Well, yeah, because you're not giving them what they need. They need clean set of financial statements. They need to know that what you're doing is a serious enterprise, not just something that's going to make money today and not tomorrow. Because you got to keep in mind, these bankers specifically, they get called on the carpet by bank examiners. And if the bank examiners say this loan doesn't make any sense because we don't really know if this company makes money, even though, like, okay, the guy says he makes money, but how can we show it? Where's the paper trail? That's the problem, because these bankers are going to look foolish, and they do not want to look foolish in front of the bank examiners or in front of their peers. So when it comes to the 4 core functions of business, let me ask you this. Are these the same skill set? The lead generation, the sales, the operations, and the accounting? Of course not. They're not the same skill set. And this is why most business owners struggle, because they can't do all 4 of these. They try to do them, and usually they just run out of bandwidth is usually what happens. They get so operationally focused or so sales focused that they get the numbers in, but they never actually have an accounting function that actually captures this. So that is the 4 core functions of business. And all of that, again, we're going to bring this right back to the financial statements in terms of what specifically you're going to be looking at in terms of a balance sheet and income statement. So when it comes to a balance sheet and an income statement, I want to make a quick couple distinctions. A balance sheet is a snapshot in time. So in other words, if I took my it's basically a sheet that lists all the balances in my account. Okay, so my checking account, in my accounts receivable, in my credit card statements, like that's what all the balances. So if I took a picture of my balance sheet in the morning and then brought in some cash because someone bought something and then paid a bunch of bills and then went online and paid some credit card, paid some stuff with my credit card, my balance sheet would be different in the afternoon. Okay, so it's truly understand, like you need to understand that the balance sheet is a snapshot in time. The income statement measures something completely different. It measures your income and it measures your revenues, the total sales, and all the expenses you pay out over a period of time. So the income statement is also known as a P&L, which is also short for profit and loss. So when you talk about a profit and loss or a P&L or an income statement, those are all three the same exact thing. It just depends on the vernacular of the individual. I'm more of an accounting purist because that's what my degree is in. That's what I was introduced in terms of an income statement, and that's what I know. So I'm just letting you know that that's the difference between, again, income statement, P&L. They are actually the same exact thing. All right, so let's get to the balance sheet. The balance sheet is specifically, we're getting into the granular details of this, but here's the thing. I just want you to understand this. For those of you who declare that you are not numbers people, chill. Take a virtual chill pill. Wash it down with some imaginary water. Here's the thing. When it comes to accounting and bookkeeping, it's not about numbers. It's about rules. And if you understand simple games like solitaire or Candyland or checkers, if you can understand simple games like that, you can understand what you need to know as a business owner from an accounting perspective. You don't need to know debits and credits. You don't really need to know what a chart of accounts is. I mean, it's kind of helpful to know that, but you don't necessarily need to know what a general ledger is or does. You don't need to know all that stuff. What you just generally need to know are just some of the basics of your financial statement and what those numbers represent. And at the advanced level, which we're not going to cover today, but at the advanced level, you're going to understand the interrelationship between a balance sheet and an income statement because they do correlate with one another. They're not just, oh, well, that just only measures that stuff over here and this stuff only measures that stuff over here. It's kind of like, the difference between an X-ray and an MRI. They're still measuring the body. They're just measuring the body in different ways. Okay, so the balance sheet, when you're looking at it, they measure three things. It measures the assets, which is what you own. It measures your liabilities, which is what is owed to other people. And then the difference between the assets and liabilities is what is known as equity. So if you take your assets, subtract, let's say you sell all your assets, you pay off all your liabilities, conceivably what is left over on your equity is what you would have left. Okay, so that is an important distinction there between the balance sheet with the balance sheet. So those three main things. Let's look at the income statement. The income statement, again also known as the P&L, is also made up of three things. Again, this is over a period of time, generally 1 month, could be 1 quarter, could be 1 year, but generally this is over a period of time. So when you're looking at your income statement or your P&L, it's made up of your revenues, which is what you've sold over that period of time, the amount of sales that you've had over that period of time, or your expenses, which is what you've paid out over that period of time, and the difference between your revenues and expenses is your net income. So if your revenues are higher than your expenses, you have a net income or a profit. If your revenues are less than your expenses, you have a net loss. So let's look at some specific examples as we talk about this in the balance sheet. So I'm going to take myself down a little bit here. If you have a copy of the book, The Time Wealthy Advantage, this exact thing came out of that book. If you'd like to read it, it's actually on page 265. But otherwise, you can just pay attention to what's on the screen, and I'll break these down so you can see them a little bit easier. So if you see here, you've got a very simple balance sheet of your assets that are at the top, your liabilities in the middle, and your equity at the bottom. Again, this is a very simplified version. So for those of you who are more advanced, again, I just wanted to keep this very basic for people. Like I don't have accumulated depreciation on here. I don't have different accruals and all sorts of different things. I'm just letting you know, like, this is a very simple balance sheet. And for most businesses, this is probably what you could expect to see. So let's look at the assets. So the assets are at the top of the sheet. So we're going to look at that first. The assets, now these are listed in order of liquidity, meaning the most convertible to actual cash dollars. So if you have cash in a checking account, you can go to the bank and just withdraw $10,350. If you have accounts receivable, that money is what people owe you to other people, right? Or owed from other people. So these are what customers owe you for work that you've done for them, right? So let's say that you're an HVAC contractor and you have people, let's say 10 different clients that owe you $101,275. Okay. Let me make a quick point on this is that if you live outside the United States and you're seeing this, you're like, does this still apply to me? Yes, because these are what follows GAAP, also known as GAAP, which is generally accepted accounting principles. And that is pretty universal across international lines. There are some nuances, but if you do business in euros or in whatever your local currency, it follows the same format. I'm just letting you know. That's pretty typical. So let me get back down here. All right. So when you're looking at the again, the balance sheet, the accounts receivable is what is owed to you from your clients. That's what they owe you still. They haven't paid that bill yet. The vehicles, let's say you got a 2019 Ford van. This is what's listed as book value. Now, book value is not Kelley Blue Book value or what it's worth. It's what you paid for it. That's what book value means. So if you bought it 5 years ago and you paid $29,970, it would stay on there at $29,970. Now, this is where accumulated depreciation would come in. Again, I'm not getting into that. I'm just letting you know it would be listed on there at the amount you paid for it. Okay, so we'll just leave it there for now. The real estate, let's say you have a warehouse and that warehouse is worth $275,000, or at least that's what you paid for, not what it's worth, but that's what you paid for, and that's what would go on the balance sheet. So your assets are listed at $417,095. So again, let's go back to the top. That's where that foots right to the top of the balance sheet. Let's look at the liabilities. The liabilities, remember, that's what you owe. This is the balance of what you owe to other people. So when you're looking at, okay, well, I've got a credit card through Chase. I owe them $34,000. I have accounts payable to different vendors. So again, let's say that you're an HVAC contractor and you do HVAC and you owe a supply house for $37,000 worth of supplies. It could be copper, it could be air handlers, all sorts of things. Okay. You have a van loan from Wells Fargo, and the balance on that is $11,570, and you have a loan mortgage with Citibank for your warehouse, and that's $105,000. So adding all of those things up, is your total liabilities of $189,180. So if you subtract the total assets minus the liabilities, that's where you're going to get the total equity of $227,915. Okay, so that is what a balance sheet is. Very straightforward, very simple. It is not complicated. So you're not going to see your income on this. You know why? Because that's the wrong thing. This is just simply a list of the balances of what you own. This is the balances of what you owe to others, and the difference between the two is your net equity. That's it. Okay. Let's look at your income statement. So your income statement is also known as a profit and loss. Again, this is made up of three components: your revenues, expenses, and net income. Again, this is over a period of time. So let's look at a sample there. So your revenues are at the top, expenses in the middle, and your net income is at the bottom. There it is, right there. So the very top, you've got revenues of $75,000 for product sales, service sales is $39,000, and you got total sales of $114,000. So you see those percentages off to the right. We're going to cover those again here in a second, but those percentages are extremely important because when you're looking at your revenues and you're looking at a month over month, this is really helpful for you to understand if these categories are moving around at all or not, because your total sales number is always going to be moving around, right? It's going to be like next month it might be 100,000 and the next month after that might be 175,000. Well, if you look at the percentage of sales, in this particular case, if you look at, so in other words, if you take 75,000 divided by 114, that's 65.8% of sales. If you take 39,000 divided by 114,000, that's 34.2% of sales. So in other words, if you had more total sales next month, and you wouldn't be able to know if your product or service sales was better or worse because you didn't have the percentage of sales there. If you have the percentage of sales, you'd be like, oh, well, my product sales actually went up. Even though my total sales went up, my product sales went up, which is great because I have higher margins on those. Okay, so that's why that's important for you to break out from that perspective. So let me, so you can see that a little bit easier. So that is your revenues. That's your top line sales. Your expenses are what's in the middle, and that is just the things that you paid for over the month. So you've got maybe raw materials that you bought, whatever that was. Maybe you had to run to the home improvement store and buy some things. Maybe you paid some bills, from last month's accounts payable or whatever it was, but that would be the raw materials. Then you've got insurance expense that you paid out that month. You've got interest expense that you paid out that month. You've got commissions that maybe you paid to your salespeople. And then you've got total wages. So all those expenses added up for that period of time, that month, that quarter, that year, whatever, would equal $96,320. That net income is what's left over. So you take your sales, subtract out the expenses, and you are left with your net income of $17,680. Okay, so that is the income statement in a nutshell. So you might say, well, what does this have to do with the price of green beans? What does this mean? Why does this matter? Why should I care? Well, this helps you plan, and it helps you be much more strategic, and especially it helps you keep from growing broke. If you have a growing business and you're struggling and you're wondering like, oh my gosh, where is all my cash going? Look, the truth is this: if you're trying to grow your organization, you cannot be strategic if you do not know your numbers. You just can't. So this is also going to help prevent you from growing broke. So there's 3 key metrics that we're going to hit in our remaining time together. And again, we're kind of rolling on pretty quick. If you guys have any questions, feel free to ask them along the way. I just want to make sure that you understand what it is that we're actually talking about here. And these are all very basic things that if you know how to use a 4-function calculator, add, subtract, multiply, divide, if you know how to do these things, I'm telling you, it's going to be super easy for you to figure these things out. It's very easy. It's not hard at all. So first and foremost, you're going to be looking at either profit margin percentage, cash balance history, or cash as a percentage of sales. We're going to start with profit margin percentage. This is pretty easy. So what we're going to do is we're going to go back to our income statement, and what we're going to do is we're going to look at that column there on the right-hand side. Okay, remember, that's the column. All those numbers are a percentage of sales. So again, if we're looking at our revenues, we've got, again, the 75,000 divided by 114 is 65.8% of total sales. Okay, so what we're going to do on the expenses, we do the same thing, but except down at the bottom, our net income is 15.5%. That's a profit margin. That is known as a profit margin. So for every dollar that we make, we get to keep 15.5 cents. Okay, so just keep that in mind. You're like, oh, that kind of stinks. Well, 15% margin is not terrible, right? It's not barn burner, but it's actually decent. I mean, most businesses I know like to be in the 20 or 30%, but generally after they struggle a little bit, they can get there if they're really intentional about controlling their costs and having healthy enough profit margin when they price things. And that profit margin is what we're going to talk about right now. So I'm going to give you a quick example, and this is what happens. Let's use a very simple example of how companies are not paying attention to the right things. So let's look at revenues. You got revenues. Let's say you have revenues over a month of $10, and you have expenses of $8, which leaves you a net profit of $2. And that leaves you a net profit margin percentage of 20%. 2 divided by 10 is 20%. Okay, so let's pretend that your expenses go up $1. Your expenses go up $1, and you want to maintain your net profit of $2. So what you do is you raise your price by $1. So again, expenses go from 8 to 9 and revenues go to 11. Let's take a look and see what that looks like. So you've got $11 in revenues, $9 in expenses, $2 net profit, but look what happened to your profit margin percentage. Your profit margin percentage went down. You are now less efficient at keeping dollars in your organization. And you might say, well, does that really matter? Absolutely it does. Because now you got to keep in mind that same $2 does not buy the same $2 worth of things today as it did last year, or however quickly inflation is working in your market. So you are actually, this is one of the ways, and there's actually several different ways, but there's many ways that companies can grow broke. And this is probably the worst of them, is that people do not raise their prices often enough or fast enough, or they don't have it, or they're not paying attention to their profit margin percentage. So what should they have done? Well, they should have raised the pricing up to $11.25. So that $11.25, so if the expenses went up $1, raising the revenues to $11.25 would brought a net profit of $2.25, and that would have actually maintained that profit margin percentage of 20%. So here's what I'm going to tell you. When it comes to this, if you take nothing else away and you're like, man, I hate this guy's shiny head, I can't stand him. Look, fine, you can hate my face later. But if you do nothing else, if you take nothing else away from this, please pay attention to this. Because this is the one thing that most companies that I see this is the reason that they're growing broke, is because they don't raise pricing aggressively enough, and they're not paying attention to this. What they're paying attention to is the raw number at the bottom. And I say, cool, can I see your last 3 years of financial statements? And if they're able to produce them for me, that's pretty rare, but if they are able to produce them for me, when I'm working at a higher level as a CSO, they generally can. And I look at it, I'm looking at the profit margin percentage, and it's usually declining. And I'm saying, when's the last time you raised pricing? When's the last time you launched a product or service where you actually had better margins? And a lot of times, very often they have not. They've not raised pricing because like, well, our customers are so good to us, we don't want to do that to them. Okay, understand, but sometimes there's ways to do this without necessarily feeling like you're going to be chasing your people off. People understand price increases. You just have to, if you don't do them often enough, when you do raise your pricing, they have a real problem with, when you do it all at one time and you might raise it like 30% and you're doing it out of desperation, not out of strategy. So I'm just saying that is a big key thing that pay attention to is profit margin percentage. The last piece of this, I'm just going to talk about those last two components, the resources. We talked about profit margin percentage. Let's talk about cash balance history. So cash balance history specifically is just simply tracking your cash. And I don't mean checking your cash. I mean tracking your cash. So I mean, at the end of each month, can you tell me with as few clicks as possible, could you tell me what your cash, what your cash trajectory is? Like, what is your cash balance history? And I do this because I don't care if my cash only goes up $1. I want to make sure that my cash balance has grown from month to month. And my cash is my wealth insurance. That makes sure that I don't run into silly problems down the road because I have not been paying attention. So I'm just letting you know, this is the sort of thing that keeps businesses out of trouble. When I actually did a study through a book called Great by Choice, and I actually went back and looked at all the numbers on my own. But Jim Collins and Morten Hansen, they had done this study of many different companies that really did well over the course of 30 years. And they looked at the comparison, their competitors as their comparisons, and they said, what was the difference between this company and that company over there? Well, most of the companies that did exceedingly well had anywhere from 3 to 10 times more cash on their books than their industry counterparts. And that enabled them to take advantage of good luck events when they came along, and it also allowed them to take advantage of bad luck events when they came along. So they were able to weather the storms when they came, and they were able to take advantage of good luck events. That's basically the whole point of having enough cash. So that's the cash balance history. And that's just something that you can simply track off of your balance sheet at the end of each month when your books are reconciled. The last thing is cash as a percentage of sales. This is a little bit more complicated, but not hard at all. It's just two numbers that you have to get, one off the balance sheet and one off the income statement. So this is what we're going to do. We're going to look at the balance sheet. Let me take myself down so you can see this. So what you're going to do is you're going to go to the balance sheet and you're going to get the end of the month balance on your checking account. Okay? So in this particular case, $10,350. Then you're going to go to your income statement and you're going to look at your sales. And that sales number is $114,000. So what I like to do is I want to know what percentage is my cash to my sales. Because if I'm trying to grow my company, I want to make sure that I'm also growing my cash balances. So I set aside enough income that I'm not just spending, I'm actually setting that aside in cash. So what I do is I take that $10,000 divided by $114,000, and that is 8.7% of sales. So my cash is only 8.7%. You might think, is that good? Is that bad? I would say if I only had $10,000 worth of cash in my bank account, over $114,000 in sales, I'd be pretty nervous. I'd be pretty worried. So because for me, I like having multiples of cash. I like to be very, very liquid because again, it allows me to take advantage of good luck events when they come along. And it was even said that when Bill Gates was growing Microsoft, he was obsessed about the amount of cash that they had on their books, even when they were really, really struggling, because his cash was his runway. He knew that cash bought him freedom. The last piece here, and again, this is where I'm actually tracking cash as a percentage of sales, where I'm seeing it go up every single month. So again, if cash, let's say sales are flat, but cash is growing, is getting bigger, then I would see my cash as a percentage of sales going up. If my sales is going up and my cash is also going up, that's even better. Okay, that's hard to do, but it is possible if you're paying attention to it. If sales are declining, cash can actually stay the same and those numbers get better. So that's where you have to pay attention that basically the numerator and denominator, you have to pay attention to how that's working. So again, this is in a case where you have either stable sales or they're increasing, but you also want to make sure that your cash as a percentage of sales is also going up. So that is, bring myself back up here. Okay. The point is you cannot be strategic if you don't know your numbers, and you will absolutely not avoid growing broke because you won't know what you're looking for. So you have to know your numbers. So just a couple of success strategies, and then we'll land the plane here today. But some success strategies, first and foremost, you have to know your numbers and you have to track your numbers. There's just no way of getting around that. You got to know them and you have to track them. And again, checking them is just not enough. Okay. I'm going to share with you a quick story here. This is actually a true story. And so if you see this, I'll take myself down again here. If you see this guy, he is a bank robber. And in the 1990s, he was robbing a bank with no attempt at all to disguise himself. Except in his mind, he was disguised. He actually covered his face in lemon juice, thinking that the lemon juice would keep him and make him invisible. Yeah, I can't even make that up. Okay. So I'm just saying, like, how in the world do you think that that's actually going to work out for you, guy? Right? That makes no sense. So when you're looking at that, I just want you to think, okay, that is, hold on one second. So what happens is these two researchers by the name of Dunning and Kruger, they saw this and they said, okay, there's got to be some relationship to false confidence here. And they came up with a graph called there's confidence on the left and competence on the right. And this is confidence and competence over time. So basically everybody starts out down here at the bottom. They're very low confidence, but they don't know very much. But they're like, okay, we're going to start out in this endeavor. How hard could it be? And they very quickly gain a lot of confidence very quickly, as you'll see the spike there. And they get to the peak of Mount Stupid, okay? And that is where they realize they don't know what they don't know. And then they have a crisis of confidence. It comes crashing down. They end up in the valley of despair. And unfortunately, this is where a lot of business owners and entrepreneurs tend to give up because it starts getting too difficult. So then they start, if they keep at it, they keep working on their competence, they work up that slope of enlightenment and get to the plateau of sustainability. So the whole moral of that story is to have a support system. And this is, again, what you just went through here today, I know we went through it super quick, but I just want to make sure that you understand, like, this is the sort of stuff where it's really helpful to have a support system so you can ask sort of these sorts of questions when they come up. So that is all I have for today's session. If you guys have any questions, you can go ahead and put them in. I don't have any more new content. I was going to hit the specifics about the business owner bootcamp for tomorrow if you are interested. And again, like I said, I don't have any new other content. So if you are wanting to do this, you can go ahead and sign up. I've got the link still up there in the chat, and I'll go ahead and just put them in there one more time. But the specifics on this, it's really going to take what we learned today and get significantly more granular. And specifics around the balance sheet, specifics around the income statement, you can ask any sorts of questions. It's scheduled for 3 hours, and that starts tomorrow at 10:30 Eastern. And yes, it will be recorded, and yes, you will get the recording. The other thing is you will also get access to the Money and Finance Advanced video course, and that sells for $37. You're going to get that for free. So you, in addition to the 30 or I'm sorry, the 3 hour session that you get with me, and you can ask any sorts of questions. And depending on how much time we have, we may just hop over into a Zoom session right after, probably about 2/3 of the way in. That way you guys can ask any questions that you have. It's probably a little bit easier on Zoom. And then from there, like I said, we'll answer any questions. But the Money and Finance Advanced video course, it walks through all of this stuff very granular, and you get access to that 100% free, and you get to keep it. You can log in as many times as you like. It's a very detailed training. Talks about everything that we talked about, from balance sheet and income statement. Even does give you a premise on what are chart of accounts and why are they relevant to you as a business owner. We're going to talk about different things from the perspective of the again, talks a little bit about balance sheet, or I'm sorry, not balance sheet, income statement, but specifically around the chart of accounts, the general ledger. That's the word I was coming up with. So all of those different things. But as a business owner, you don't need to know how to do debits and credits, because that's not what you need to do. You're not going to care. Talk about different types of infrastructure that you can put in place, different types of accounting software that you're going to need, something more than a simple Excel spreadsheet. I'm sorry, but you need that infrastructure, and you need something that is something more than just you are inputting. So all of these different things, then we're going to get into actually being bankable and how you actually translate this from just the accounting and bookkeeping world into being bankable, and making you bankable, and how all of that interplays with you and your business. And again, the reason for being bankable is so you can get your personal credit cards out of the business. And I'm not suggesting that you necessarily, like, I don't know, man, I run a lot of charges through my account and I get lots of points. Listen, you can have a business card that does the same thing. You can get points on your business cards now. Like, that's not an uncommon thing. So when we're talking about business credit and how to do this, there's all sorts of different things that you need to know. And then we can start talking strategy. Then we can start talking about different metrics and creating flash reports and understanding things like accounts receivable aging and accounts payable aging and all of these different things that are going to be relevant to you. Okay. So that is everything that's going to be in the course. And the business owner bootcamp is going to take what we learned today, and it's going to get significantly more granular. So you guys, when you're walking out of there, yes, you're going to have a lot of knowledge and you're going to be hosed down with a fire hose, but you're really going to come out with a much better understanding and much more confident feeling about your finances in your business. Okay. So that is everything I have. I've got the link on the screen. And by the way, I did mention this earlier. I will mention it again. If you get to the end of the course, or let's say that you get to the end of tomorrow and you're like, okay, yeah, this was a complete waste of time. And, you logged in and you checked the course and you don't like it. And you're like, I don't want this at all. I will give you your money back. I have no intention of keeping your, again, it's $39, but again, it does not change my life at all. I'm just keeping it affordable for people who can actually make it there. And if you don't like it, I will happily give you your money back. So I just want to make sure that, again, this is all on me to perform. And I just want to make sure that you have all of the tools that you need in your toolbox. All right. Well, you guys were a quiet bunch today. That's all I got. All right. Have a great day, guys. And I will see you guys in the boardroom. Take good care.